Unlike other schools of thought, we're not just appealing on things like confidence to talk about the economy unwinding. There's actually real structural reasons why it must unwind. As an aside, it used to be the role of the central bank to, and I quote, take away the punch bowl just when the party starts getting interesting. Now, however, what we tend to see in this phase is as soon as people start to waver and people start to feel as though they're feeling a bit sick, the central banks are essentially handing out more shots. The next phase is a credit crisis. Credit crisis follows from an inflationary boom. The equivalent of a credit crisis in our analogy is essentially the state of kind of nausea or vomiting or whatever people do when that kind of inflationary boom just reaches its peak. This is where the shortages become apparent. It's when the entrepreneurs that are trying to build these houses all look down and realize that there's not enough bricks to finish their houses. We tend to see a spike in commodity prices, tend to see a spike in consumer prices as well. Central banks may be increasing interest rates because they see this inflation and they become concerned by it. Banks are concerned about the fact that businesses are not able to pay back their debts, so banks are now calling in loans to preserve their balance sheets. Companies are going to be scrambling for funding. Interest rates are probably going to jump up because firms and banks are unwilling to lend to each other. Also note that the crisis is going to be strongly felt in the banking system. It's the loan portfolios that are going to deteriorate and these highly leveraged investment projects that will prove to be unprofitable that will mark the onset of the crisis. Now, the problem here is that if companies all need money and banks are unwilling to lend, the only thing they can do is to sell assets. So if all of these companies are now having to sell assets at a similar time, this essentially means a fire sale. They're going to have to make a loss on these assets in order to liquidate them. And we see the next step, which is a recession. Did that come up? Yeah. Okay, so now we are basically in our hangover state, in our hangover phase. This is when firms are recalculating their investment plans based on the realization that they'd overestimated the amount of growth. They'd overestimated consumer demand, and they'd overestimated the amount of resources in the economy. This is when this illusion of wealth becomes revealed. Just note, this isn't where inefficiencies are being caused. This is how the economy is correcting the previous inefficiencies. To talk a little bit about policy, what do we need to do at this point? Well, what we tend to do at this point is try and freeze the economy and keep everything the way that it is. Okay? But what we need to realize is that the economy in 2006 in the UK was not a healthy economy. There were structural problems with it then, and a desire to get back to where we were in 2006 is just going to go back to the inflationary boom that started things off. Now, if the boom-bust crisis ended here, we probably wouldn't see this as a repetitive pattern, right? If we go out and we get drunk, then we have a hangover, and then that's it, then we're probably not going to go out and get drunk again. What's the next stage here? We have a recovery, right? Can everyone see why the recovery is important? Because it's the recovery that kind of kids you into forgetting what the harm was in the recession and basically leads you going back into this crisis in the second round. Okay? Now, in theory, there's many reasons why we might expect this cycle to kind of go on and compete. In reality, we tend not to see this going on and on, because what we tend to see, and what we're seeing now, is an inability to get through a recessionary phase, and therefore as soon as there's the recession, as soon as the hangover kicks in, we immediately try and go back and create artificial growth. So why is it that we end up in this cycle? Why do we keep reliving this, and why is this something that we kind of see not just in the UK and the US in recent years, but pretty much across all countries and across all economic history we see this? Well, the main thing that's underpinning this is debt, and in particular public debt. Why is it that governments get into debt? Well, quite simply, because they want to spend money, and quite simply, it's very difficult for them to tax enough money to be able to spend. Generally speaking, the public want the government to spend lots of money, but don't want to be taxed for it. Now, there's really three ways in which a government can get money. The first is by borrowing, so i.e. debt. The problem with this is that it's not a long-term strategy, because at some point you have to pay it back. So the next way to do it is through taxation, but taxation is very visible and it's very unpopular. If you try and fund spending through taxation, you'll get voted out. So the only real alternative to get rid of this, to cover the cost of spending, is through inflation. right, where inflation is a reduction in the value of money. There is really a fourth way, which is selling off government assets, which we often talk about. So when we're talking about Greece, it's not just debt, taxation, and inflation at their disposal. They could sell off assets. I'm sure there's lots of islands that various other countries would be willing to spend money for. We are filming. Okay, I'll scrap that bit. Okay. Now, I often, when I teach and I talk about this, people still kind of ask the question, why is it the government inflates? Why do they inflate? Let me quote Ben Bernanke, chairman of the US Fed. People know that inflation erodes the real value of the government's debt. Therefore, it is in the interest of the government to create some inflation. What does inflation do? It makes money less valuable. Who wants money to become less valuable? People that at some point in the future need to pay back money. Okay? So if you're a debtor, inflation is a wonderful thing. The biggest debtors in the economy tends to be the government. Therefore, we all understand why it's in the interest of government to have some inflation. There's a myth that we're living in a great moderation, right? That we live in a world of low inflation. From 1997 to 2008, the consumer price index ran roughly between 1% and 3%, which is why we kind of tend to think that we live in a world of low inflation. Just note that CPI doesn't tell the whole story. There's lots of asset classes that don't count under CPI, for example, house prices. So it's now ludicrous to say that in 2004, 2005, we were living in a world of low inflation. We just realized that it wasn't showing up in the CPI measure because it was involved in things like house prices. But also, 2% growth over a period of time builds up to be a high growth rate. Now, I just want to cover a couple of the costs of inflation because this is something where most standard economics textbooks get right, but they don't tell the whole story. So we all kind of know, if you've done A-level economics or undergraduate or anything, the costs of inflation are things like there's a tax on money balances, right? And inflation is a form of taxation. It erodes the value of savings. So if you have a period of inflation, then pensioners are obviously going to have a decline in their purchasing power. Inflation redistributes wealth from creditors to debtors, so it means that people are going to be less likely to supply credit. But also, and this is the distinctly Austrian point, or the Austrian school point, there's also costs involved in the changes in the composition of the price level. So we tend to think that when there's an inflation, prices all go up, okay? Or when there's a deflation, prices go down. In actual fact, if there's an inflation, some prices are rising faster than others. And the whole point is, where do you fit into this economy? And do you feel your price rise is going up before your wages, or do your wages rise before the prices go up? Depending on where you are in this cycle, it determines whether or not you benefit or you don't from inflation. But what we tend to see is, because these price changes are occurring discretely, we see resource misallocation. We see what's known as Cantillon effects, which means that depending on where the new money enters the system, we're likely to see a bubble in that area. And there's also an inducement of forecasting errors, because you as an entrepreneur find it difficult to tell if your profit is being driven because people want to buy more of your product, or whether you are profitable because there's inflation and prices are rising. Now, if there's a problem in the market for shoes, then we're going to have adjustments in the shoe market. And we'll probably also see adjustments in markets for complements of shoes. However, if there's a problem in the money market, every other market needs to adjust in order for the money market to get back to equilibrium. Therefore, as soon as you start messing around with money, and as soon as you start messing around with the value of money, you are basically opening yourself up to an economy-wide correction.